Hi folks, this is RAJAT Bose from Kolkata. Hello, I would like to ask you a question. How much interest you are getting from your bank deposits? 5%? For senior citizens, 5.5%? Interest rates are moving up in our country, so probably you will get sometime down the road 6% or a little above that. Maybe that is the case. Now, I would like to ask you a second question. Have you ever thought what you bought, what you used to buy, regular life, leading your life, your monthly expenses for whatever you bought last year, and the same thing when you were expending this year, how much extra money you are paying? It must be more than 5.5–6% or whatever. I guess it would be nothing less than 10%. Do you understand that you are actually going through a financial repression? When I say financial repression, I am actually telling you this, that the inflation rate, it is not just the CPI which you get to hear, you get to read in your newspapers or in television. It is not that. I am telling you about your personal inflation index that you will be able to calculate by if you have kept your records that how much you spend for household expenses and other things last year and how much you are spending this time. That is your personal inflation index, and you are definitely seeing one thing, that your money's purchasing power has actually gone down. If you buy the same thing, you have to spend more, and if you spend the same amount, you are getting less. That means your money's purchasing power is going down. So that means that the interest that you are earning from your bank deposits or things of similar kind, those instruments, that is not sufficient. Every year you are actually losing out. If you are a retiree, then the problem is compounded even further, because you do not have any other source of income. You are actually living on your pension, living on your fixed deposits, whatever. Now, I have something to suggest which would be good. But before that, let us take a break. Well, if I tell you that investing in stocks is an option, most of you will tell me, no, I'm not interested because it's so difficult, it is so volatile, and it is fraught with a lot of danger. I don't want to lose my money. Of course, these dangers are real, but these dangers are real only in case of your investing your money for the short term. Over the long term, you actually could be gaining a lot if you do. It isn't as if you will not face volatility, but over the long term, meaning when I say long term, I am talking about 5, 10, 15 years or even more. What is that option that is so easy to handle, and yet you will actually be making much more money? But before that, I would like to enlighten you about the history of the stock market and how it has performed. The most difficult part in the stock market is day trading. Only 0.01% of the participants in the market who come in for day trading or short term trading, they make money. That means 1 in 10,000 will make money. And the easiest thing where you will surely or most likely you will make good money, but people don't actually opt for that. That is investing in good long term stocks. Now you would say that long term stocks, good long term stocks, how would I choose? Who would help me? I can't watch the television all the time, or I would not be able to fix which one to go for. I have a simple solution to suggest. And mind you, lot of people who are actually very intelligent. They are intelligent investors. Some of them have written books and they have become bestsellers and they are regarded as big authorities in this area. They actually opt for index funds, and I am actually talking about index funds, and they are planning to live with it for the next 25, 30, 40 years. So, you can also do that. Now, you have already come to know that I am recommending you index funds. What are index funds? Index funds, when I say index funds, I am actually referring to the broad market index, like in our country it is the Sensex and the Nifty. There are exchange traded funds on this thing. When I say exchange traded funds, that means it is traded in the market, in the stock exchanges. At the same time, there are index funds who are not listed, but index fund is a passive thing, in the sense that an index fund actually invests your money in the same stocks that the index is constituted. That means the 50 stocks that are in the Nifty or 30 stocks that are in the Sensex, you will be investing in them. When you are investing in the broad market leading indexes and funds based on them, you are actually investing in the best of the best blue chip companies in the country. Your risk is that much less, because here neither you nor there is a fund manager who would be choosing a stock and that choice may be good, may not be good, something like that. And the record that is there for index funds, be it here, be it elsewhere, be it in the United States, be it in India, the record is that very few fund managers generate a return over the long term that is higher than the index funds. Of course, there are people, but they are few and far between. I mean, less than 10% of the total fund managers come even near it. Over the long term, most fund managers actually underperform the index. I'll give you an example. There was a very famous trader come investor who used to work for George Soros, Stephen Druckenmiller. His CAGR, that is compound annual rate of growth, in his fund was 36% for the 12 consecutive years. Phenomenal. When you are actually growing your fund at 36% CAGR, compound annual rate of growth, that means every 2 years you are doubling your money. If that is the case, you can understand such humongous gains that Druckenmiller made. But come the 13th year, he lost most of it. If you are investing in an index fund, it doesn't happen, because index funds, of course, it has got no downside protection. That is, if the market goes down, your fund will also go down. But as you have seen in 2020, that when the market fell by 5,000 points from 12,500 Nifty level to about 7,510 or so, at that point of time, what happened was even the index fund suffered badly, because if the Nifty fell by about 40%, your index fund would have gone down by 40%. That downside protection is definitely not there in the index fund, yes, but just see what has happened next. Today the index is about 17,000, 16,500, whatever. So, that time it was 12,500 high, from there it fell, and now it is 16,000, 17,000, it has even gone up to 18,000. And let me also tell you one more thing. India is considered as an emerging market. India is considered as an emerging market among the various stock markets in the country. Now, United States was an emerging market right from the late 1800s to right from 1900 to about 1950. It was also an emerging market. Today, it is the most advanced market in the world. And when it was an emerging market, then the markets in Britain, France, Holland, rather the European markets were considered advanced markets. Generally, an emerging market continues to remain an emerging market and continues to grow unless of course you actually get clamped down by the fall of capitalism and totalitarian system comes in or something. If that is not the case, leftist totalitarian regimes come, then stock markets may not be there. If that kind of a catastrophic situation doesn't happen, emerging economies tend to perform, especially India is actually one of the largest emerging economies now. History suggests that if we began our journey at 1990s, early 1990s, it is likely to continue for 50-60 years. That means up to 2050, our country net will continue to show economic growth. In between there can be some hiccups and all that, but over a period of time we will definitely grow as we have grown from 1990 to current date. So, you need not bother. If your horizon is long, then you can definitely invest in index funds and make much better money than any of the instruments. Suppose if you are thinking that I would not invest in bank deposits, I would move to some other kind of debt instruments. If you choose debt instruments, one advantage of investing your money in bank deposits is that there is deposit insurance and there is good banks, too big to fail banks. If you invest in them, the RBI would take care of them and Deposit Insurance Corporation will help you, all that is fine. But if you invest in some other private sector debt instruments, there could be problematic scenarios like what happened in DHFL and all. But if you are investing your money in an index fund, that is the Nifty index, I am not talking about sectoral indices like Pharma index fund, IT index fund, no. They may be a flavor for some time, that their flavor will go at some point in time, but when you are investing in the Nifty, you do not have to bother, because the last 30 years what we have seen that whenever some stocks, some major stocks are not performing in the indices, especially in the Nifty or so, it is those counters are removed and new stocks which are actually blue chip stocks and performing well, they are added to that index. So, you are always invested in good stocks and they are performing well, so you do not have much to bother. So, that is the reason why I am suggesting that index fund is definitely a major option. You should consider this as your major option. Otherwise, you will continue to face financial repression. Think about this. Although currently we see that the interest rates are going up, RBI has already indicated that interest rates are going to go up, withdrawal of monetary accommodation, all these things. Keep this in mind. RBI is not just the monetary authority, RBI is not just setting repo rates and reverse repo rates, which are actually determinants of interest rates that is prevailing in the market. RBI is also a merchant banker for the government of India. That is, the government of India, when it comes to borrow money from the public, RBI actually manages that, and it is RBI's duty to actually procure that kind of debt funds, the money that goes into those kind of GSECs, that is government securities, at a lower interest cost, because RBI has to look after the government of India's interest, because it is government of India that owns the RBI. So, you can understand that debt instruments, you may keep them. You should definitely keep a part of your money in bank fixed deposits, which you want to access very quickly, like going tomorrow and you actually encash, you break your fixed deposit, you get some ready liquid cash. But if you are investing in an index fund, there is also the similar kind of liquidity. Maybe you will not get the money the very next day, but you will get it within 3 days. There is an advantage. Another advantage of index fund is this, that is, when you are investing in index funds, you do not have to do much of choosing by yourself. You can decide to invest in one index fund, or you can decide to invest in say 3-4 index funds, because tracking error or expense ratios come into play. Expense ratios meaning what is the annual expense that it does. Like on an average it is about 0.29, 0.3%. So it is the least costly fund that you can actually opt for. Other funds managed by fund managers, you will have to pay much higher annual charges. So that way it is also a cheap option and a very good option, very good option. Now, I haven't found in my 30 years of experience, I haven't found anything better than this for the common people. You can definitely think that your own or somebody you know or some fund manager in whom you have great faith, it is possible, but it has been seen that no fund manager on a yearly basis every year will perform better than the index. It is not possible. There are exceptions, there are people like Warren Buffett and all, but we do not have access to such people. So we have a very easy option, that is investing in index funds. And just think about it, that early 90s when Nifty began its journey, and today say maybe within 30 years we are now at 17,000, 18,000 kind of levels. So your money, by putting your money simply in index funds over the 30 years, you have actually multiplied it by 18 times. 18 times, that is the track record. On the other hand, suppose on an average if you have been investing at 7% FD for the last 30 years, you have actually your money would have gone up by how much? By 8 times. That is, every 10 years your money would double, and you would tend to doubling, then it will be quadrupling, and finally in 30 years you would be seeing it at 8 times. And if you are a fixed deposit holder, your interest rate is far higher, and when you will be paying taxes on capital gains for an index fund investment, it will be much less. Currently it is 10%, 10% compared to say the 30% or 35% tax that you would have to pay on your interest income. So from that perspective, it is much more tax efficient when you look at the long term. So this is your panacea for long-term financial betterment. I hope I have been able to convince you as to why you should. And mind you, I haven't recommended any particular index fund as such, because I don't need to, and you don't need to bother about who is your fund manager. But I have provided you with an option which I were told when I began my journey. It's a surefire thing. Over the long term, if you believe that India is going to grow, if you are optimistic about India, if you think that Indian economy will perform, then index funds, the Nifty index fund, the Sensex index funds, I am not talking about any sectoral funds, I am talking about the broader indices, the most popular indices, the index funds based on them. My choice goes of course to Nifty index funds because there are 50 stocks there, that is why, but even Sensex funds perform fairly well. I have been receiving a lot of comments, not just through YouTube comments, but also in WhatsApp, in Facebook, other places, through also on telephone, and I am trying to incorporate them. Continue watching my videos. If you like them, press the like button, subscribe to my channel, and also do not forget to press the bell button.